If you're like me, you love the idea of having tax-free income in retirement from a Roth IRA. That can really help you stretch your savings a lot farther after you stop working. However, there's a catch. If you earn too much money, you can't contribute to a Roth IRA. But the good news is that you can still get Roth benefits, even as a high earner, using the Mega Backdoor Roth. This is a strategy that can help you save a lot more for retirement and make entirely tax-free withdrawals. So this podcast will review how the Mega Backdoor Roth works, who can take advantage of it, and even more Roth strategies when possible. Welcome back, everyone. Thanks for joining me. I'm Laura Adams, a money speaker, spokesperson, award-winning author of several books. You might be interested in grabbing a copy of Debt-Free Blueprint, How to Get Out of Debt and Build a Financial Life You Love, or my most recent title, Money Smart Solopreneur, a personal finance system for freelancers, entrepreneurs, and side hustlers. Money Smart Solopreneur was a #1 Amazon new release. And both books are available as paperbacks, ebooks, and audiobooks, so I hope you'll check them out. Before we get started, I want to thank a reviewer on Apple Podcasts who says, I'm a 23-year-old and finding this, my goodness, has been a help, starting from motivating me to take care of my financial responsibilities and learning about things I didn't have a clue about. Thank you so much. Well, thank you. I really appreciate that wonderful review. And if you're also enjoying the show or have used it to level up your finances, I would love to get your rating or review in whatever podcast app you're using right now. Or if you have a question I can answer on the show, call 302-364-0308 and leave a voice message. And you can also send me an email using my contact page at lauradadams.com. And while you're there, also hit the button to sign up for free to The Money Stack. That's my newsletter that you can get via email or in the Substack app if you are a Substack user. All right, so let's talk about the Roth IRA. If you've been listening to this podcast or you've read any of my books, I'm sure you already know that a Roth IRA is an individual retirement account. It requires you to make non-deductible after-tax contributions, but its tax benefits come later. It comes in retirement when you can take withdrawals from the account that are entirely tax-free, which I love. I'm trying to get as much money as I can in Roth accounts because the idea of having tax-free income in retirement is just too good to pass up. If you have a Roth IRA and follow some simple rules, you could have colossal investment growth in the account and then skip paying tax on that growth entirely. Those tax savings could be massive, depending on your account earnings. Another Roth IRA benefit is that you can withdraw your original after-tax contributions at any time, penalty-free, because they were previously taxed. But taking earnings from a Roth IRA would be subject to income tax and an additional 10% penalty if you're younger than 59 and a half. However, your contributions and earnings are tax-free if you've owned the account for 5 years and are over 59 and a half. That gives you a lot of flexibility with a Roth IRA that just isn't possible with other retirement accounts. Another benefit is that, unlike traditional retirement accounts, Roth accounts have no required minimum distributions at any age. Therefore, you, not the IRS, control when and how much to take from your retirement account. You can take tax-free money from a Roth as needed, or just let it grow tax-free indefinitely for you or your heirs. For 2024, the maximum IRA contribution is $7,000 or $8,000 if you're over 50. And you can make IRA contributions if you've got earned income and no matter your age, up to your tax filing deadline for the previous year. So the qualification for a Roth IRA is that you have to have that amount of earned income. But also, since a Roth IRA offers so many excellent tax benefits, the rules were created to shut out high earners. So if you exceed an annual income threshold, you become ineligible for regular front door contributions. And by the front door, I mean directly contributing to a Roth IRA using an after-tax source, such as your checking or savings account. For 2024, the Roth IRA income cutoff for singles happens when you have a modified adjusted gross income, or MAGI or MAGI, of $161,000 or higher. Married couples filing joint taxes cannot contribute to a Roth IRA when their household MAGI is $240,000 or above. But I'm going to explain ways to get around the income thresholds and legally boost your Roth funds anyway, so stay with me. Note that there are no income limits if you have a Roth at work, like a Roth 401k or a Roth 403b. That's why I encourage you to use it for all or a portion of your retirement contributions when possible. So again, the Roth IRA is the only account where your income is a factor for eligibility. Now, let's talk about the idea of having traditional or Roth retirement accounts. I want to review some considerations if you're unsure about whether choosing a traditional or a Roth retirement account is right for you. I mentioned required minimum distributions, or RMDs, that are a requirement of traditional retirement accounts. Depending on your account balance, those RMDs could be hundreds of thousands of dollars per year, and they get taxed at ordinary income rates, which are some of the highest. And having that extra RMD income could even result in you having to pay taxes on most of your Social Security retirement benefits and increasing your monthly Medicare costs. However, Roth accounts have no RMDs. That applies to Roth accounts at work and Roth IRAs. They have no RMDs, and as I mentioned, are tax-free, eliminating these potential tax side effects. If you believe your income in retirement will be higher than today, using a Roth is wise. You'll pay a lower tax rate today instead of a higher one in retirement. And even if your income in retirement will not be higher, you might strongly believe that tax rates for all Americans will rise in the future. So maybe you won't have more income, but your tax rate will be higher. Or maybe you just don't want the hassle of paying income taxes to the federal and state governments, depending on where you live, on your future retirement income. All those situations or beliefs are reasons to favor loading up one or more Roth accounts. Okay, if I've convinced you that putting more money in a Roth is good for your situation, you may wonder how to do it. Well, if your income is below the thresholds I mentioned, you can make direct Roth IRA contributions, and that's up to $7,000 or $8,000 if you're over 50 for 2024. But if your income is higher and it makes you ineligible for those front door contributions, or maybe let's say you just want to make a higher level of Roth contributions, the Mega Backdoor Roth could be a really nice legal workaround. It requires 2 steps. Step number 1, you have to make after-tax contributions to a traditional workplace retirement plan. Step 2, you have to convert those after-tax contributions to a Roth. So let's break that down. For the first step, you have to be enrolled in a workplace retirement plan like a 401k or a 403b, and that plan must allow after-tax contributions, which is not the same thing as making a Roth contribution. If your plan allows after-tax contributions, that may enable you to save more than the typical annual limit. For 2024, you can contribute up to $23,000 or $30,500 if you're over 50 in pre-tax or Roth contributions to a workplace retirement plan. But here's the trick. The rules say you or your employer can contribute a lot more than that. You can contribute up to $69,000 or $76,500 if you're over 50 in all types of workplace contributions, not exceeding your annual income. So for most people, that will leave an additional $46,000 in potential after-tax contributions, which could come from you or your employer. For example, let's say you're under 50 and you make $100,000. You could contribute an additional $46,000 to your retirement plan at work. Here's the math. You've got a total of $69,000 minus $23,000 that you're putting in pre-tax or to Roth contributions, leaving you $46,000 for after-tax contributions. Now, let's say you're under 50 and you make $60,000 a year. In that case, you could only put in an additional $37,000. The math would be $60,000 as your maximum amount minus $23,000 for your maximum contribution. The difference is $37,000 for after-tax contributions. Again, your contributions can't exceed your annual income. So that brings us to the second step, which is converting your after-tax contributions to a Roth account. So any amount of after-tax that you put in, it could be up to that $46,000 or it could be less. If you have a Roth option at work, you may be able to convert that after-tax amount from your traditional 401k directly to your Roth 401k. This is known as an in-plan Roth conversion. Now, let's say your workplace plan doesn't allow that. You may be able to roll over your after-tax contributions to a Roth IRA. That's known as an in-service withdrawal. So whether you convert after-tax workplace contributions to a Roth 401k or a Roth IRA, there would be no taxes except any earnings on those contributions. But if you do a rollover quickly, there should be minimal account gains for taxation. So to sum up, being eligible for a mega backdoor Roth depends on what your workplace retirement plan allows. You can use this advanced strategy if you can make after-tax contributions, and you can do an in-plan Roth conversion or an in-service rollover. Some plans may allow an in-plan conversion, but not an in-service IRA rollover. If your plan does not allow either, you're going to have to wait until after you leave the company to do a mega backdoor Roth conversion. So review your plan documents or maybe speak with your benefits administrator about what's possible. If you can set up a mega backdoor Roth, you'll make after-tax contributions to your retirement plan and periodically roll them over to your Roth at work or your Roth IRA. Some retirement plans even have a feature that automatically converts your after-tax funds at regular intervals to the Roth account of your choice. So how do you know if doing a mega backdoor Roth conversion is right for you? Well, it depends on various factors, including what financial goals you have, what your workplace retirement plan allows you to do, how much you've already saved in Roth accounts, how much you're currently saving for retirement, what your tax rate in retirement could be compared to your current rate, how a Roth conversion would affect your taxes, and whether you already have both pre-tax and after-tax amounts in the account, making distributions subject to the IRS pro rata rule. And I'm not going to go into too much detail here, but I am going to put a link in the show notes to more information about that. To sum up, with a mega backdoor Roth, you can contribute up to an additional $46,000 for retirement in 2024. That's on top of your regular plan limits of $23,000 or $30,500 if you're over 50. Now, let's talk about what happens if you earn too much to contribute directly to a Roth IRA, but you don't have a workplace plan. You don't have a workplace Roth. Well, there are 3 legal ways to still boost a Roth IRA. One is to max out a Roth IRA in any years you do qualify. So let's say your income dips for some reason. Maybe you get laid off, you don't receive a bonus, you have a less profitable business year. In those cases, your income may dip to the level where you do qualify for a Roth IRA, and in that year, you want to take advantage of it. The second way is to make backdoor Roth IRA contributions. So everyone qualifies to make backdoor Roth IRA contributions using after-tax funds you contribute to a traditional IRA and then roll over to a Roth IRA. So with the mega backdoor, you're putting after-tax funds in a traditional workplace plan. With a backdoor Roth IRA, you're putting after-tax funds in a traditional IRA and then rolling them over to a Roth IRA. And the third way is to do Roth IRA conversions. So with a Roth conversion, you move funds from a pre-tax source, like a traditional IRA, to a Roth IRA and pay income taxes on the full amount. There are no annual income limits or contribution limits on Roth conversions. In other words, you can convert as much as you like from a traditional to a Roth account each year, and the IRS will happily take your income taxes, no matter how much you earn. For example, let's say you want to convert $50,000 from your traditional IRA to your Roth IRA. Your annual taxable income increases by $50,000, and that significantly increases your tax liability for the year. If you're in the 22% tax bracket, you'd owe up to $11,000 in tax on the conversion, but that tax could be even higher if the extra income pushes you into the next higher tax bracket. If you want to learn more about these 3 ways to boost your Roth savings, be sure to check out Money Girl episode number 768 called Too Rich for a Roth IRA, 3 Legal Ways to Have One. And speaking to a tax professional or a financial advisor before making any retirement account moves is always best. You want to get guidance on whether paying taxes now is worthwhile in exchange for future tax-free Roth benefits. As I mentioned, I definitely think it's worthwhile and would encourage you to do your research, find out if there are ways that you can save more for retirement and also get more money in Roth accounts so you have that tax-free income in the future. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. It's audio engineered by Steve Rickyberg. Our director of podcasts is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.